We will begin our lesson by discussing basic characteristics of bonds. We learned last chapter that a company can issue stock if they need to raise funds. Projects that need a lot of money often are financed with bonds. Issuing stock is called equity financing because the company is giving up equity or ownership of their company. Issuing bonds is called debt financing. This is because bonds are a form of debt. Essentially, the company is borrowing money and will need to pay that back. Bonds have an interest component. Most bonds require the issuer to make periodic interest payments. These interest payments are usually made semi-annual, which is twice a year. The advantages of bonds are that they do not affect owner control, which happens when issuing stock. The interest on bonds is tax deductible. When issuing stock, companies will sometimes pay out dividends, which we learned last chapter. Dividends are not tax deductible because they are not categorized as expenses. Bond interest, on the other hand, is an expense and will therefore reduce net income and the taxes to be paid on that income. Bonds can increase return on equity. A company that earns a higher return with borrowed funds than it pays in interest on those funds increases its return on equity. This process is also called financial leverage or trading on the equity. Bonds do have their disadvantages, though. Bonds require payment of both periodic interest and par value at maturity. Par value is also known as the face value, and we will cover what that means next. Issuing stock does not require any payments because dividends are paid at the discretion of the owner. Just like bonds can increase return on equity, bonds can also decrease return on equity. A company that earns a lower return with these borrowed funds than it pays in interest on those borrowed funds decreases its return on equity.